Perfect. We start the recording. So once again, guys, Happy New Year. I wish you a wonderful 2019. And remember, there are things that are in our hands, and trading is in our hands. How good will that be for you is in your hands. How well you will structure it for yourself. How well will you learn from the good things you do and from the bad things you do, and this is how trading will look like. So my best and warmest wishes. This is a super classico of cycles webinar. Maybe it will not be absolutely new material for some of you, for the dinosaurs of, of the club, but I wanted to have this webinar to make it clear and remind you what is the classic, or as I call the super classical. And I'm not talking about Real Madrid and Barcelona in a football match. I'm talking about the classical structure of money flow as we see them on the cycles. For the question is that PowerPoint will be downloadable later? The answer is yes. It will be inside the video in the media zone. I also will email that and publish that in the Telegram group, so everything would be available for you guys, as always. So you know how my presentations go. As always, I'm asking your full focus. Please ask relevant questions. Don't try to guess what I will talk about later. Whatever the question you have, please make sure you are asking about the things we speak, about the things I show and explain. If anything of that is not clear, ask, please. But if I start to talk about cycle, don't ask me about divergence and so on, okay? So please keep it straight to the point in terms of questions, and I will keep it from my side straight to the point with the presentation, okay? So let's begin. Today's menu: warm up about cycles and divergence, turning principles, the super classical combinations, examples of course, small loss, high profits trading idea and examples coming from it, the myth of trading and the truth about them. I want to talk here about several points that are very, 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 very important to talk about them, to discuss about them, and mainly to make you as traders face them. Because you know, when we are facing the charts, we tend to forget the reality. We tend to forget the psychological barriers. We tend to forget many, many important things because the charts are so tempting, especially like happened yesterday with the crazy moves. So we tend to forget these very little important things, and that's why I do want to raise them up again. And the winner mindset for successful trading, the way I see that, it doesn't mean that's the only way. That means that that's the way I see that. And again, same little things to remind ourselves. And please note, this webinar is not to teach the basics of cycles or divergence. For the basics, please refer to the other webinars available in the media zone inside your members area of the Traders Academy Club. Everything is there for you, okay? All the webinars. This webinar is a bit more advanced, so I assume you have the basics to understand the cycles and their principles, okay? And not to teach the principles. So let's do a quick warm up of the cycles and the divergence before we dig deeper and go to the hardcore of the super classico. By the way, later today, there is a super classico in England for all those of you who love the football matches, right? Liverpool, Manchester City, the new super classico. So enjoy it. If you are going to watch it, enjoy it. Cycles is, from my point of view, the direct representation of a money flow. Now, there are those who call it price action. There are those who call them waves. There are those who call them whatever the other name you can come up with, we all rely on the same idea: price change, right? From point A to point B. How will you name it? It doesn't matter. For me, it's a money flow because it represents how the money is moving from point 1 to point 2. And from these points, we are looking for structures. The clearer the structure, the better the flow of the money is. Meaning, if you see something like that, and then wow, my mouse is going crazy. Hold on, guys. If you see some crazy moves like that, and then some not clear moves, that's a clear say from the market that there is nothing happening, big money is not involved. However, if you see your trend structured, right, you understand that there is a very, very, very well structured, planned, and organized moves of a money flow. The idea is simple. The big money is not coming from the spot market as we know it, as we trade it. The big money is coming from the derivatives, a word that so many of us hate, probably for a good reason. I'm talking about options, futures, and so on. There are many, many different instruments that design the long-term moves. That's where the big money is sitting. The spot market as it is almost not in use. And I say almost because there are still branches and hedge funds that are trading spot market. There is nothing wrong with that. It's amazing. And I'm trading spot market in 99% of my trading. So that's important to understand. But the big money, the money that designs these waves, is the money that comes very well from all the derivatives and other instruments. And sorry, when you see the structure here, it means the big money is building here an option with protection levels, with longer term calls to finish here, and even longer term calls finish here, with add-ons after cashing out on every of the retrace level. When you see that, very well, clear move, that's where you will want to be. And that's why cycles help us with that purpose. If you can define the cycle clearly, you have a money flow. You have money involved. That's where you will want to be. There is a great saying, as you know, if you can't beat them, join them. So instead of trying to beat the big guys, try to understand what they are doing, why and how, and what are the principles they rely on, and join it. Learn to enjoy from it instead of trying to guess where will be the next bounce from support or resistance, where will be the next breakout, where will be the next whatever. Okay? Instead of guessing, speak their language, use their language. And that's where the cycles come to our help. Well-structured cycles show a clean flow of money in specific instrument you are analyzing. Cycles have main three groups. Double cycle, which could be broke into the three categories, 61.8 and 161.8, which are the golden numbers, and the 100% levels. We are talking about Fibonacci expansions. Okay, so basically we are measuring the first wave and its correction to try and to see where will be the second wave. 61.8 would be here, 100 would be here, and 161.8 would be here. Okay, yes, there are future numbers like 261 and 361 in rare cases, but that's the three we work for the double cycle. Triple and special cycle, that's the second category of the cycle. That's three waves cycle, which means one movement from point 1 to point 2 broken into three well-structured portions of the money flow. Okay? And we have the range, which is, in that case, less relevant for our super classical needs. All right? So far, so good. Or as I love to say, all good in the wood. So that's how double cycle could look like. And we have, as we already know, 3 waves. 100, the classical A equal B, right? That's the 100 level. That's the second one. This is the 61/8 level. And that's the third one, 161/8 level of Fibonacci expansion. Okay? Rules of each of the legs you can find in the other cycles webinars. As I said before, I'm not going to teach the basics here. We are just making a warm-up. That's pretty much how it looks like. Okay? That's 61/8 Boston creations, 1, 2, and then 1, 2, we have to the downside. The same one that caused these little pushes on the last several weeks to the upside. That's 100% duplication, the first example. And the second example is a classical 161/8 example. Which Fibo level is the most common one? That's a good question. And the answer for that would be 61/8. Why? Because this is the first level to be reached. Will that reach after that 100 or 161/8? You don't know, right? So 61/8 is the most common one. And also treated as a golden ratio in a cycle. I like the best 161/8 for one reason. On 161/8, you might get the best risk reward in your trades, and normally on the 161/8, it's easier to spot super classicals, which we will learn today. It doesn't mean that's the only one. It's just the one I prefer. Oops, what did I do? Okay, now let's discuss about a triple cycle, 3 wave pushes. Okay, so the classical one is this one, where A is equal B is equal C, right? Now I love them a lot for one reason, because you are able to drop a channel on the tops and the bottoms boundaries, right? Like a border here. When you create a channel, you have also very clear visual following of the price, and it helps when you make your analysis and your levels. It helps visually, of course. A is bigger than B is bigger than C. This is what we call a descending triple cycle. Each of the ongoing legs is smaller than the previous leg. And the ascending one is growing legs, where B is bigger than A and C is bigger than B. Right? So that's ascending triple cycle. So here is an example of a triple cycle, how it looks like. There are, of course, many more of them, but just a quick example. Okay? And that's why, for all those of you who remember, that's why we were looking to sell the dollar yen here, or with one more false break, due to the cycle that we have here. PC, how do we know the size of the money flow by reading the chart, or is it relevant to important money? You mean how much money is really involved in that? No, you can't know that from the chart. This you can have a read from exposure to options and expected expirations. It's much different subject than this webinar, of course, but no, you can't. From the chart, you can't. I wish there was a way. This is the special cycle and how it looks like. Quick reminder, again, the family of a triple cycle, as we are speaking here about 3 wave pushes, right? 3 pushes, upside or downwards. And what we want to see is the first and the last legs to be equal, pretty much. If any of them is a bit bigger or a bit smaller, no problem. We can't expect for perfection on every single chart. It doesn't exist. It's impossible because the market is not a perfect living organism. It is changing. Right? There are too many factors influencing it every single second. So we can't expect for perfection, right? It's like expecting for a perfect weather every single day so you can do your habits like skiing or whatever it is, right? It's impossible. And we can wish, but we can't really get it. And the middle leg here should be double or triple the size of each of the first or the last legs. Very simple. So if this one is X, X, and this should be double or triple X. Okay? And a quick example for special cycle, that's how it looks like. All right? So far, any questions, guys, before I move on? I love this question. What do I think is going to be between Liverpool and Manchester City? I love this question, but it doesn't have to do with the webinar. But I think it will be draw. Just a guess. All right, so no questions here. Yeah, there is question. Yet, if FIBO is still relevant for special cycle? Yes, wonderful question. Let me go back here. Perfect question. The Fibonacci expansion for special cycles. The classical and the most popular is 161.8 or 261.8 in deep expansion. In very rare cases, you might face 361.8, very, very, very rare cases and very expanded lags. But that's the most common ones. And the best part is when you can also make relations not just between point 1, 2, 3 and get the Fibonacci expansion, but when you also can get ratio between point 3, 4, and 5. Then when you can get basically on this cycle, when you can get your ratios, right? So both, let's call it this way, A, B, and C. When A is related to B plus C, and when B is related to C separately, that's when you have a beautiful special cycle ratios. Again, it's pretty rare, not so common, but happens. Alexander, for triple cycle, to project the third wave, we draw the Fibonacci expansion from the first wave. Well, let's go back here, this one, right? So as with the special cycle, in triple, it's more popular. When you have your A, B, C, you measure from wave A, so this, and its correction, right? And then you get the projection of that. And then separately, you measure B and C, this and this, and you get a projection here. When you get a magnet zone, right? Synchronization of levels, you get yourself great chances for a great action. Okay. Ahmed, this is a great question. Can we find cycle in every chart all the times? The answer is no. Never. Sometimes cycles are in creation. Sometimes there is no money flow. If there is no money flow, you would never be able to find a cycle. And my personal view wasn't always, remember that please, wasn't always will remain If it's obvious, it's tradable. If you start to, maybe it's a double, maybe it's a triple, maybe it's a range. Let's see what the higher time frame say. Oh, the higher time frame doesn't have nothing. There is missing part here. When you start to miss too many things and you start to find yourself convincing yourself that there is a cycle, then there is no cycle. And how can you know that? By observing the chart. If you can't combine waves by the rules with the ratios between the legs, and there is no divergence, which we'll discuss about in a minute, there is no cycle. Normally, it will look like something like that on the chart. There is no way you can build up anything in that place. Okay? Again, when it's clear and collectible, it's tradable. When you start facing a situation where you convince yourself, maybe this, maybe no, maybe I'm missing something, maybe this, most likely it's not. Okay, so that's my personal view. That's a great question, PC. Like yesterday, the flash crash that we saw out of nowhere, some pairs touched the 261.8. Is that considered to be a special cycle? No, never. That's randomness. This is out of the technical world. You can't measure that. You can't rely on that. So in that case, it bounced from 261. In other cases, it would bounce from 161 or 361 or just 321 level that doesn't mean nothing. Complete random moves. It's too easy to say and believe that like there is always technical levels. Oh, look at this bound. Oh, there has to be a reason. No, not always there is a reason. Many times prices react random with big orders close at specific levels and so on. When you see things like that, like happened yesterday, the most common mistake is to start convincing yourself there is a technical reason. There is no. And wait at least few hours, better a day, before you make your next decisions. Okay? Such moves are not technical. Okay? Correct, Roberto. In such cases, you ignore it. Or at least wait it to get structured. One spike will not affect you on nothing. And should not affect you on nothing. Right? If you plan to go to play football, but when you open your window in the morning and you see there is a strong wind outside, it doesn't mean it will be there in 1 hour or 2 hours. Maybe a bit later it would get better. Right? It will not affect your decision for the rest of the day. I hope this example is answering the question. Ahmed, how can you know when there is no cycle? What? Not sure I understand. We just discussed about it, no? Yeah. All right. So here we are, cycles and divergence. Again, I assume you guys understand what divergence is, okay? And this is the combination. The rule is very simple. Every cycle that ends must end with divergence. That's the rule. And it could be any type of divergence, regular, continuing, or extreme. It doesn't matter, but it has to be the ending divergence, right? No divergence, most likely cycle did not end. And if you see something like that, move up and move down without any divergence on this end, that means that all that belongs to some bigger cycle and it's not over yet. So ignore. As always, If it's not clear, don't try to clean it. If the market doesn't make it clear for you and the signs are not obvious, don't try to find a reason. Treat the ones that are clear. There are more than enough of them. Don't try to find a reason. Oh, so if it's just a V pattern or a zigzag back and forth and there is no divergence, so what do I do? Not always there is something to do. Always remember, check the bigger picture. Maybe there it's clearer. Right? Always. Higher time frame is clearer than the smaller one. Always. Whatever you would see here, something like that, all this craziness might be a simple, classical, beautiful cycle on the higher time frame. Okay, so remember that. It's very, very, very important. No divergence, most likely cycle didn't end, as we said before. For best trading scenarios and levels, we want to find cycles on at least 2 time frames that will tell us the same story. So for example, we have a double cycle on weekly, triple cycle on daily, and we have the magnet zone, and we have the divergence on the same direction. Same story, right? Same story. Running into ending zone from the magnet zone, from a respected level, with divergence, boom. That's where we want to be involved. Okay? Multi-time frames confirmation gave us clear light on the money flow in the instrument. The clearer the picture you can combine, especially if it comes from few time frames, the better the chances you would find a real trading opportunity. Will that turn into a winner? No guarantee. Never was, never will be. But you have yourself a better starting point, meaning increased chances to have that as a winner at the end. This is how it looks like. Okay, each of the cycles would have the divergences, and the higher the time frame, the better the read you will have. Double cycle here with divergence, double cycle here with divergence, double cycle here before it turned to be triple, yeah, with divergence, the triple with divergence, double with divergence. Okay, and here, do we have anything at that moment when you see on the charts? Can you find double cycle here? No, you can't. There is no divergence. Can you find a double cycle here? No, there is no second leg. So that's uncyclable. Okay, we just made up a new word. Uncyclable. Okay, Ahmed, that might answer your question. Not always you can force it to be a cycle. That's not a cycle, that's not a cycle, and that's not a cycle. So in that scenario, you have nothing to do based on the weekly combinations. Okay, so the best way to work with cycles in general is always start from the last available point. So that's your last available points. Cyclable or not? Is that, and then if it's not, go to the previous points. Okay, is that cyclable? No, it's uncyclable. Okay, then go to the previous points. This, is that cyclable? No, it's not. Okay, you got it, guys? So basically, always start from the last point and grow, go backwards. And then you get yourself clear picture on few of the cycles. Now, for example, the last cycle we've had was this double cycle, and it reached the 38.2 of its retrace. Game over, right? And no, not always you can find a clear cycle on any of the time frames. And if you don't have it, that means there is no money flow related to this time frame. As simple as that. It's building up. How will that build up? We cannot ever know. We trade facts, not wishes, expectations, or dreams. Okay? Question about any of the divergence plus cycles related, guys? You like it? Isaac, I like it too. Actually, uncyclable is good, right? We just made up a new word. It seems that we're going to use it in 2019. Cyclable or uncyclable? I like it. I like it too. Even didn't plan that for the webinar, so. Good. Any questions, guys? If you have any, hit me. Alexander, does continuing divergence be reliable most of the times? Well, not sure I understand the questions. Nothing is reliable all the time. This part you know. Regular divergence is stronger than continuing one. And it does not mean that continuing is not reliable. If continuing fits in your cycles, then it's very reliable. If the continuing does not fit in your cycles, better don't do nothing with it. Okay. All right, good. So let's move on, guys. We are now in the next subject, and we are talking about turning principles. Sometimes when any instrument is moving without a stop in one direction, our human brain screams us, it's time for a reversal, right? Have you been there ever? I've been there too many times in my life, in my trading life. When you see something going one way, you start to convince yourself there must be a reversal. Nothing goes in one way, right? It's normal. It's normal to expect that. And many traders, I saw this discussion also in the chat recently, in the Telegram chat, and it's pretty much good discussion, right? Because many traders obviously look at things like if it's 3 days or 4 days or 5 days or 6 days straight in the same direction, there has to be a correction. There are no rules for that. If you start to go back test, you would find enough example for retraces after 3 days and after 4 days and after 5 days and after 10 days. There are the examples for everything, but there is no any mathematical or logical or trading principle or logic behind it. There is no rule or law or obligation to see something on the charts always happening. The market is always a living organism. It means that it's changing and it's affected by too many factors. Too many factors in every single second. So you saw that yesterday, the best way, right? This random move out of nowhere. That's technical? 100% not. Is that predictable? The answer is never. Is that tradable? Only if you are lucky to be part of it. And remember, if you get lucky, someone else got unlucky and going to pay for that. There is no money out of nowhere. This money has to come from somewhere. So many times, the big guys, they know these things we think about, right? Why? Because, well, they've been there. They did that. They designed them, so it's easy for them to know them. They setting traps around these levels, and it's important to know how to avoid them. And I would like to discuss about these things, if you don't mind, about these little traps. Let me go here, guys. Look, this is what I'm talking about. What happens at that point? Okay, we are now here. That's our price. What happens at that point? Now we see the triple cycle. Let's assume there is divergence there. And we want to go sell. Right? Many traders, or most of the traders, what they do, and again, it doesn't matter if it's cycles, that could be Elliott waves or Wolf waves or Gann cycles or whatever it is, or just a channel. Okay? Every trader finds a reason or maybe just support resistance or trend line or whatever. But we find a level and we say, oh wow, it's been a long journey up. It must go down, right? Have you been there? Did you say that to yourself? I am pretty sure the answer is yes. I know I was, and I did. So what happens here is we start to, let's assume this is a weekly chart, just for the case of the example. Then what do? We drop to 4 hour or 1 hour or worse, 15 minutes. And we say, oh, wow. Oh, wow. Think about it this way. Let's say this is your weekly and that's what you see on the 15. Suddenly, you see lower highs, lower lows on the 15 minutes. How exciting will that be for you? Right? Let's admit it, it will be extremely exciting. Why? Because you're opening your chart, prepare your daily work or your weekly work, and you see that and you say, oh, wow, it looks like the beginning. And I might be the one that will call it top for this point before it crashes. But I have news for you. What happened, you remember the movie, What Happens in Vegas Stays in Vegas? Same here. What happens on 15-minute time frame stays on 15 minutes time frame. It has nothing to do with the definition of the next higher time frame trend. Nothing to do with that. So what you see here most likely will end up somewhere here, causing you scratch your head several times. And that's not because you didn't use Head and Shoulders shampoo. It's because the market knows to drive you crazy in these times. And when you find yourself finding amazing technical setup on 15 minutes or 1 hour chart, but it fails once, you immediately start looking for the next one. Not anyone specifically here, but normally. That's what traders do. Why? Because we immediately say, but how come it was amazing technical setup with divergence, lower lows, everything? How come it failed? And it's very important to remember that lower time frames have nothing to do before the higher time frame is ready. Now the big guys know that. They know you will make these mistakes. They know they can drive you crazy. So what they do is they set traps here. How? They make these lower time frames to be sexy for you, right? They put a little candy there, or a piece of chocolate, or a glass of beer, cold beer, just came out of the freezer. And you watch it and you say, I must get a sip, or I must get a bite, right? And boom, you got beaten. That's what happens. How does that happen? What they do is they increase on the lower time frame. They give you the sexy options, I call them, right? The sexy options. What does that mean? They attract you on the intraday or medium terms. They attract you with increasing numbers. So you see puts, right? Let's say this is a price of 1.40, and you see the next level 139 and 138. Just for example, I give you numbers, okay? And 137, you see the numbers going and increasing. So more and more money involved here on the short-term expirations. Now, you don't see that on the charts, but I tell you what happens behind the scenes. They attract you. And by this attraction, that's where you will see on the 1 hour chart or the 15 minutes some sexy patterns, some head and shoulders, some fallback, some lower lows, some breakouts, whatever it is, right? That's what happens. They attract you. But on the same time, what happens is they increase the numbers of calls on a bit longer term. So when you see something like that, you get excited. They kill the position, they drop the position, or they sell further put to earn their commissions. So they earn the commissions, you pay for the money on that by them increasing the numbers for longer term expirations. And that's why many times you see something like that happens. Boom, 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 boom. And only then you see a real retrace of lower lows, lower highs. So behind the scenes, that's what they are designing. They make it look so amazing for you by setting these traps. And you don't see the numbers, but you do see the structures on the lower time frame. And that's how they make it look like. While parallel, they increase the numbers for longer run. So they attract you with small money, then they resell it or purchase back, and boom, you are already attracted. You are already in. But that's what we call a mousetrap, right? So that's what happened behind the scenes. Now, how do we spot the good reversals or the more reliable reversals? There are a few principles on that, and this is the next discussion. Any questions about that as for now? That's a wonderful thing, Ahmed. The false break is best to be on the same time frame of the cycle. It would be the best conditions. The lower you go, the more aggressive it becomes, the bigger the chances you would be wrong. 100% correct. Or if not the same one, then one lower. But when you start to go aggressive and you start to just say false break on two lower time frames, or worse, what traders do is go from weekly to 1 hour or from weekly to 15 minutes, it's impossible. It's impossible. Okay, so it's like trying to plan your, trying to organize your ski bag or going to the beach bag, right? Let's say use the beach bag when it's winter. It's irrelevant. You will prepare your bag during winter for a beach, which would be relevant in 6 months. It's not relevant. And same here, okay? Some actions are simply irrelevant, wasting our time, wasting our focus, wasting our energies, and mainly wasting our money. And you know what I love to say? If you don't pay attention, you pay money to these little things. Very simple. So that's very important to understand that behind the scenes, these guys know exactly what the traders will do. And it happens because of our human brain. Whatever goes up has to go down. Whatever goes down has to go up. In logical, it sounds perfect, and it's correct. The problem is that logic and reality not always meet themselves in the same place and the same time. And most traders are in a rush, right? When a new TV is launched or a new phone is launched, you saw what happens in the out of the stores. Queues like crazy, right? After a month, the price would be much better. After another month, the price would be even much better. But the majority, they don't care. They see the opportunity, they want it now. Now. And same happens here. Most traders see a resistance, support, trend line, Fibonacci, or a divergence, or channel, or whatever it is, they want it now. But the market doesn't care what we want. The market cares about facts and what it wants, not what you want. And the sooner you understand it, the better it will be. So the most common trading principles are false breaks, convergence, and higher highs, higher lows reverse. Let's talk about the good one, the false breaks. False break is a failed attempt. This is the basic one, right? The more aggressive one, but still important. The false break is a failed attempt to create a new significant high in an uptrend or a new low in a downtrend. False breaks should be followed by any divergence. by a divergence, sorry, for extra reliability. At the end of an uptrend, we will want to see a bearish divergence. At the end of a downtrend, a bullish divergence. And this is how it looks like. Uptrend, fake attempt to get a new high, bearish divergence, move down. Fake attempt to break a new low after a downtrend, divergence, move up. Move down, false break, divergence, move down, false break, divergence, move up, false break, divergence. Now, a trained eye of you might see fact that false breaks with moving average divergence considered to be stronger than with any other type of divergence. This is true. There is a lot of discussion and agreements or this between traders, what's stronger, histogram or moving average. In general, moving average are much stronger. The most strongest one, divergence, is combination of both. Then just the moving average and then just the histogram. Depends on the market condition. Each of them should be used in different cases. For example, for false breaks, moving average are stronger, that's true. The strongest is when you have both moving average and histogram. For hidden divergence, for example, then histogram is the important one because it represents the volumes. It's not real volumes, it's just a representation of the volumes, the distance between the moving average. Okay, so it depends on the conditions. That's where the importance. For false breaks, that's what we want. That's what we have. But that's how false breaks look like. Failed attempt to create a new high in an uptrend or a new low in a downtrend, followed up with divergence. Ideally, on both histogram and moving average. Not ideally, or less ideally, moving average only or histogram only. Okay? Convergence is an opposite situation to a divergence. Divergence was a tool we used to identify an end-of trend and possible reversals. Convergence is a situation we identify to confirm a trend. Ideally, convergence comes as a follow-up to a divergence. So divergence first, convergence then. In convergence conditions, we will see rhyme between the price and the indicator. MACD histogram is what we use for convergence. Okay, so here's the idea. Uptrend, false breakout, bearish divergence, and lower lows. Right? Lower lows on the chart, lower lows on the histogram. Okay, move down, false break, divergence, and convergence. Okay, this is the idea of the convergence. Again, I'm not going to go deeper in that because all this information is available for you on the other webinars. I assume you know that. It's just a reminder. Okay. Ahmed, can we identify false break with continuing divergence? Yes, you can. As I said before, with moving averages divergence, it would be stronger. Okay. Turning principle, higher highs and lower lows. Sometimes the market is not Mr. Perfect. So we need to have tools in our arsenal to deal with that situation as well. Not all the situations are, as we said before, psychable. Not all the situations are tradable. Most of them are, and you need to understand the principles of the reversals to be able to deal with that completely and surrounding all the conditions, right? Higher highs, lower lows stands for, HHLL stands for higher highs, lower lows. You know that. After a downtrend scenario of triple higher highs and 2 higher lows will hint for trend reversal. After an uptrend, scenario of triple lower lows and 2 lower highs will hint for a trend reversal. Now here's an example. Aussie franc, 2 waves, there is no divergence in between. Now, yes, of course, if we dig deeper, we can see, oh, that's an extreme almost. RSI next to 20 MACD completely new low? Yes, it's almost an extreme. But between these 2 points on a cycle, there is no divergence. Now we might go to higher time frame and see what's going on there, right? To get a clearer picture, because maybe that was just a correction to something bigger before it does that. That's also an option, right? So if it's not clear here, always check on the higher time frame. But this situation is what I want to discuss about. No divergence that we could spot, but still we not a good color I chose. Let me just choose a different one. So what we have is 0.1, 0.2, 0.3, 0.4. Now this is very important. Why? Because we have this structure 1, 2, 3, 4, right? In the majority of cases, 1, 2, 3, 4 pattern is a corrective pattern, meaning that if you had a downtrend before and you get 1, 2, 3, 4, you could expect a reversal and continuation in your original trend. And this is why this pattern is so important, because if it doesn't make it and 4 is broken to the upside, that means you are possibly developing now a structure in a reversal, meaning 3 possible waves, right? This point was broken. So that might turn to be triple cycle or maybe even special cycle. We don't know how deep that will be, but we do know there is now a sign of a reversal. So what we have here is 1, 2, 3 higher highs and 1, 2 higher lows. Right? This happens when point number 4 is broken. So basically, low, high, low, high, then one more low and breakout. Like here, low, high, low, high. This is a mini low and breakout, right? This is broken. And then you get yourself this structure. Okay? That's a turning point, and it's very, very important to understand where it comes from. It comes from the 1, 2, 3, 4 that at that point here was considered to be as a possible continuation down, because there was no divergence against, there was no ending divergence here. So on 80% of the times or 90% of the times, you would see here the breakout and continuation for one more low to complete the divergence, most of the times. Sometimes it won't happen, and the breakout would be 1, 2, 3, 4, breakout and continuation. Okay, that's very important to understand that. Now, the super classical questions before. Where we are. Roberto, is it good even if we don't have the 2 candles rule? Well, I'm not going to dig deep in the 2 candles rule in this webinar. You do want to respect them. If you don't have the 2 candles rule, remember, if you can find the, instead of 2 candles, double wave retrace, then you can name it. Yeah, I know. This is probably what you mean, right? Here. On the lower time frame, you would be able here to see the double wave retrace, and then yes. Okay. No problem. All right. So any other questions, guys? Perfect. So the super classico multi-time frames combination give us the best observation on real and healthy flow of money, as we discussed before. At any given instrument, we want to trade. Meaning, if, for example, we rank the weekly time frame and the daily time frame to tell us the same story, expectations to the upside or expectations to the downside, we have better odds to be right in our trade. But a super classical is a unique combination, which means if, and I'm talking as for example, weekly time frame is a double cycle and each of its legs is identical cycle, any type of it, double, triple, or special, not range. On the daily time frame, you have the best chances to make a winner. Okay, by saying that, let's have a look on some of the recent situations we were dealing with in our trading. In the live rooms, it was previous year. Hard to say, hard to believe we already talk about it this way, right? Like history, previous year. But it was the end of 2018. It was triple cycle on the euro versus the Kiwi. And each of the legs from the weekly time frame was a cycle by itself on the daily time frame. Same cycle. In that case, triple. So this was the weekly, right? 1, 2, 3. And each of its legs was a triple cycle on a daily. Each of them ends with divergence. So each of the daily cycles is validated as a cycle by itself, right? And of course, it's very important to validate it. So we come to this place and we see, okay, so now we have a false break. Is that a good sign? It's a wonderful sign for two reasons. First of all, we are very close to a monster psychological level, 1.8. It's a monster. Second, we don't go to the 1 hour chart to find our false breaks. We are dealing with the confirmation time frame, the daily time frame. We don't go lower. It's very strong, right? Because if you would go to 1 hour chart, you might be facing the fake attempts much earlier. Okay, we also have the structure of 1, 2, 3, and a breakout. We don't have a convergence here because the MACD did not create for us here lower lows. It did much later, right? So our turning principle were after we combined the weekly and the daily. So weekly was triple. Each of the daily cycles was triple. Each of the weekly legs, sorry, was a cycle by itself on the. So again, each of the weekly legs was a cycle by itself on the daily time frame. That's how it should be, right? Each of them was triple. Each of them was confirmed with divergence, and we got yourself a false break. An amazing candle pattern, which I admire, as you know, that's kicker on a psychological level. And then you got yourself the structure of lower highs, lower lows breakout, and no opposite divergence to give you any sign of a stoppage. Okay. Michael, question: are cycles important if it ends with divergence but not Fibonacci levels? No, they're important both. The level give you the cycle level, and the the magnet zone we create. Divergence give you the confirmation. It has to be both. Next one, the DAX. The monster triple cycle upside with a monster divergence. The weekly is a special cycle by itself on each of the monthly legs. Each of these legs, each of these cycles, sorry, is a cycle by itself and with divergence by itself. And the ending part here was brutal. False break, and again, you see, we don't go to 4 hour chart, we don't go to 1 hour chart, we are facing it on the higher time frames, on the confirmation time frame. False break, psychological level of 13,500, divergence on moving average, and we know how strong it is on with false breaks. Lower lows and convergence. Sugar. As long as this low holds, sell the rallies is the plan. From here and from here and from here and from here. Right? So again, the steps. You choose the higher time frame. That could be any. Your starting point could be any. You could start with weekly, you could start with monthly, you could start with daily, you could start with 4 hour. The higher, the stronger. And one lower time frame has to be a cycle, the same cycle on each of the higher time frame legs. So you start with the higher time frame, you define it to be, let's say, whatever the cycle is, for example, double. Then on the lower time frame, each of these double legs must be a cycle, same cycle by itself. And they have to be validated, of course, with the divergence as well. You can do that, you get yourself a very likely winner. Then confirm a turning point. Kiwi CAD, who remember this one? We were riding the sell all the way on the first part of 2018. Then we switched, and you all remember the rally. Well, all of those of you who were in the academy and that part of previous year. So double cycle, and each of the legs is a trio on the lower time frame. Each of them verified cycle. Turning principles. Now we can't use the false break here as a definition for an entry because we go one more time frame lower. You don't want to be so aggressive. False break, just a false break without anything else would not be enough if you keep dropping on time frames. Okay, so you do want your extra. You get yourself convergence principle here by making higher highs and turning points. 1, 2, 3, 4, and breakout. Boom. All combined together. If you miss the first party, most of the times there is second party. Triple cycle, double cycle, bullish hidden divergence, and continuation. You know these parts from the cycles. Now this is the principle of the super classical. They are much less frequent than any other cycles because it's, you understand, the more conditions you want to combine, the less chances it will appear, right? It's logical, right? But when it happens, that's where you will want to be involved. Now, the best part of it is this: the small loss, high profits trading. As you know, trading is a business of statistics. That's not new, right? To improve them, you need to focus on two main factors. One, small risk, big potential reward trades. Two, best odds trades and improved timing. And this you do by the turning principle we just discussed. And remember, the lower you go on time frames, the more aggressive your trades become, the more chances you would be wrong in your timing. Very logical. Remember the example I gave you before. If you start to pack your beach bag and prepare your kayaks or your boats when it's just December and it's a winter, you would not be able to enjoy it. So it will be packed, it will be ready, so what? Same here. If you start on a lower time frame before your higher time frame is ready, don't expect the market would be care of you. And if it would, and you got lucky one time, don't think it will be a repeating thing. Okay? It's very important to understand, guys, because it's too easy to ignore it. Too easy. We all have this inner voice. It will be fine. It will be fine. Right? And we all have this separation in our in our brain. Today I want to be more conservative, tomorrow I want to be more aggressive. Right? And whenever you try, you find yourself making wrong decisions. When you want to be conservative, you need to be aggressive. When you want to be aggressive, you need to be conservative. The best way to understand that is to understand the principle of these turning points we discussed. False break is reliable on the higher time frames. When you drop lower time frame and you say, oh, there's a false break, it might mean nothing because the higher time frame is not ready yet. Okay? Convergence could be applied on the lower time frames because on the higher time frame it will be much bigger waves and might take all your cycle development. You got it? So it's important to understand the logic of each turning point and when to apply it. Now the super classical cycle combination offer that exactly: small loss, high profits, probabilities, not guarantees, not warranties, probabilities. Entries on the big money trap zone. Remember, what happens here is the big guys started to design the traps starting from here because so many traders start to sell here, fail here, sell again, fail again, give up, and then the move happens. It happens after very well structured traps. And these traps would happen normally on the lower time frame. The lower you go, the more traps you would be exposed to. Very simple. Very simple. Amazing risk reward trades probabilities. We discussed about that. And the best part of this kind of trading, and this is why I love it so much for my investments, you need only few trades to make an amazing returns. Less time in front of a monitor, less mistakes, less trades, potentially more profits. Pretty straight to the point. Okay, so let's go back to the euro versus the Kiwi example. We got our false break, which is on the confirmation time frame. We don't need to go to 4-hour or 1-hour chart. We're dealing it here. Psychological level. Amazing kicker. Divergence on the moving averages. All the super classical cycle, everything is with us. Plus we have the the lower highs, lower lows principle all together. You are riding. Up to where are you riding? Until you get divergence against you. At that point, all this right, there is no divergence against. It happened only here. You see how strong the move continued from here to here, extra 600 points or so. And then opposite divergence. You got the turnaround and the divergence on histogram and moving average. That's your exit point right here. That's where you make your money. Same New Zealand and CAD, the one that we discussed before. Running without any obstacles, no divergence against. No divergence against, nothing to end the divergence. It ended only much higher here. Again, moving averages and histogram. And then, of course, we got few more things, right? It was a cycle by itself. It was a clearance zone here, catching all the stop losses. It was a classical point, right? To cash out all the journey. And this journey started by combining the super classical cycles from weekly through daily through turning points, all these things together. And it was also 20 candles, right? That's correct, Michael. That's very, very correct. That's how I see a great divergent student. Awesome. And you also see that here, right? 20 candles, right? Okay. That's a good question, Derek. So where do exactly do we enter the trade? Right? Now, as I always say in all my live rooms, how will you enter your trade? It doesn't matter. What strategies you use, it doesn't matter. What does matter, you have it done after the right timing. So when you approve that, super classical, when you verify all the things that should be verified that we just discussed, you can start trading your positions. And the strategy, if it's after falls break, if it's after convergence, if it's after retraces and trend line breakouts, if it's any of the trading systems, it doesn't matter. What does matter, you do it after you get verification of the higher time frames, because then the chances are with you. I myself love to do it as an invest. When I see the super classicals, I love to do it as an invest. By the way, this is one of the things we have on the dollar CAD, right? How's that? Dollar CAD. Weekly is a potential trio. Daily is a double, and here it could be and that part it could be any special, triple, or double. All of them would be correct. I would measure it like this. Okay, so that's the idea. Weekly, triple, daily, confirmation for each. That's why we attacked it today. Now, what did we have today that we didn't have yesterday? First of all, we got a beautiful engulfing yesterday and 4 holding tops on the same level of daily chart, but mainly this principle that we discussed today. 1, 2, 3, 4. And also this low is broken. That's why I sent you today the investment is triggered. How and will that be developed? I don't know. But I know we have our conditions. Okay, so you understand, guys, where it comes from? You see where it derives from? Again, weekly, daily, each of them is a super classical combination, right? Verification. We also got Fallsburg here, to be honest, right? It was between these tops. So a false break and a false break on the next top also could be considered. But we also have the turning points. 1, 2, 3, 4, boom. Okay, so again, how will that be developed? No clue. But as long as we are good to go and everything is set correctly for us, we are there. Does that make sense, guys? You understand? You understand these combos? That's the decisions I love to do when I trade investments. And it's good for all the instrument. That's how I do my stocks. That's how I do my commodities, my indices, and my forex. And no, I don't need 100 trades per year. I will be satisfied with 5 or 10, as long as they are by the book and give me the best chances. That's all I need. I need increased chances. That's all. And that answers this question. So should we trade more to make more? My personal view is no, you don't. You need to trade more correctly. And that you can do when your setups are clear. This is something you understand as you grow up as a trader, right? Exactly like in real life, there are things you understand as you grow that you didn't understand when you were younger. Same here, right? When you are young, you tend to do the mistakes. You tend to convince yourself it will be fine, right? You tend to think you are smarter than everyone else. You tend to think you know better, and it doesn't matter what the adults will say. It will be fine. That's what we all told ourselves when we were younger. So same in trading. The sooner you accept it, the better your trading would be. And now, guys, I would like to talk about some myths of trading. Everyone can be trading. Completely wrong. And here is why. Most traders come to the world of trading because of advertising online. These gurus on Instagram that drive the Bentley or Ferrari, they don't belong to them. They rent it, or they just take picture next to someone else's cars, or some huge houses, or some jets, or helicopters, or whatever it is, some yachts, right? These Instagram guys, these Facebook guys, these YouTube 2022, 24 rock stars that pop up like mushrooms after a rain, and they disappear on the same speed. That's why most traders come inside the same dream that they sell. Now, let's admit it, without marketing of selling a dream, there was no market, and most likely you would not be involved. So the marketing is bad, but on the same time it's good because it attracts you to a correct market that could make you into a trader. Would it happen? Not everyone can be a trader, and that's why I want you to see that, face that, accept it, and understand that. If you are here just to make money and you don't care about the charts, forget about it. Never gonna work. You can't be a doctor if you don't care of medicine. You can't be a restaurant owner or a chef if you don't care about the food and the quality of the food. You can't be a supermodel or a professional sportsman without paying its price. Same with trading. For all those who come here just to make the money freedom dream come true, forget about it, guys. I'm sorry if I'm the bad guy exposing your dream bubble, but this is the reality. And this is why the generally in trading, so many negative people discussions. That's why. And it's important to understand that. So can everyone be trader? Theoretically, yes. In reality, no. Only those who are ready to dedicate what it takes and pay the price it takes would be able to grow as a trader. You need to decide to which part you belong, guys. Okay? Now, another myth, you need to bring capital to trade. Again, totally wrong. Many traders believe that without having big money, they can't succeed. The truth is that if trader proves to be successful, even with a tiny capital, there are ways to fund this account with big numbers. Investors are hungry for real good, reliable traders. And the truth is, if you can't make profits with small account, you would never be able to make it with big numbers. Because big numbers are scarier to trade. With small numbers, if you think it's scary, with big numbers, it will be even worse. That's the truth. So to get a capital, in nowadays, it used to be a problem years ago. Nowadays, everywhere. Even we are working inside the academy currently with one group, the Fivers, and you have the link to them inside the members area, right? Trading career opportunities. And soon we will be able to work with more organizations. I'm always looking for reliable guys to work with. Guys that private companies that provide capitals to traders that prove themselves. Very simple. So you don't need a big capital from your pocket. That's totally wrong. You need a good strategy to be successful. Well, that's partial truth. It is true. But strategy brings you in and gets you out in a trade. That's what strategy is, or system is. Before you do that, you need to understand what is going behind this thing that you are doing, which is called trading. You can't drive a car without learning how to first. You cannot climb a mountain before you understand all the risks around it and how to hold correctly, how to tie up yourself correctly. Right? You can't before you understand all the around the action. Same with trading. And here is one, a good one. You can trade any time of the day, any day. Now this is completely wrong. Now imagine you have a pizzeria. Okay? Can you make clients always be there whenever you wish? Can you say today I'm going to open at 12 p.m. Tomorrow I'm going to open at 4 p.m. The clients will be there. I will sell. No, you can't. No, you can't. The market doesn't care of what you want, what you wish, what you dream. The market moves when it's ready to move, when there are enough reasons for it to move. So all these strategies that work exactly at 10 a.m. or exactly at 9:30 p.m. or exactly at specific time, specific session, specific condition are good in some periods, are terrible in others, like any other strategy. So don't expect that to be something realistic. It's not true. It can't happen. Okay? You cannot make the market move, and you cannot make it to pay you when you want. You can't find a setup or force a setup if there is none. You do that, you pay for it. I want you to remember the simple logic. If you buy the euro dollar, just for example, at 117, and after 1 hour it's still 117, you can't make money, and it doesn't matter how much you wish. You simply can't. Okay? And remember, if there are no setups now, there won't be setups after 1 hour as well. It won't help you if you stay glued to the monitor. I want you to remember the fridge metaphor, which I use in my presentations, and it works like that. You are watching a game. You are sitting on your comfortable sofa in your living room, and you are watching a game. Then you go to your fridge to find something, some snack. You go to the fridge, you open it, and it's empty. You go back disappointed to your sofa, and after 5 minutes, you go back again to the fridge, now with the dreams of, oh, maybe I missed something, maybe there is still a snack. And you keep repeating that, always going back disappointed to the sofa, right? Expecting different results. Same traders do with the charts. They watch now, they go make a coffee, they come back after 5 minutes looking in a 1 hour chart or 4 hour chart, expecting to see something different. How? Why? What will be different if the 4 hour chart candle or 1 hour chart candle even not closed? I want you to remember always, a false break happens after a long time. Even if it's 15 minutes, to create that will take several hours. So if you would be glued all the time from here to here, I'll tell you what happened. You would end up with taking Advil or Tylenol or whatever the pills are, or you get frustrated, or you get angry and you're gonna fight the people around you, or you're gonna hit the table saying, what the heck is going on with Mr. Market? That's what happens when you watch the charts endless. Avoid that. And here is a very important thing, guys. The winner mindset for successful trading, the way I see that. Understanding that not every trade will be a winner is number one. We all want all of them to be winners. We all want every single step we do in our lives to be a winner. Can't happen, will not happen. Doesn't matter how hard you try. We are built to fail and to learn from the failures, to try and avoid the same mistakes in the future. Ability to admit mistakes and cut positions early. When you understand that there are signs against you, don't play a hero, play smart. Cut, tighten, do action. Don't fill yourself with emotions, hopes, and wishes. Wait for your setups. Do not create ones. If there is no setup, it will not help you. Let's say you trade with Fibonacci retraces, and there is no Fibonacci retrace. So, but you would still want to trade, and you go to the chart and you say, but there is support, there is resistance, there is trend line. It should be good, right? Right? When you start to say that, you increase your chances for a mistake dramatically. Grow and slow, slow and grow, sorry, or fast and blow. Remember this motto. Never glue to the monitor. We discussed about the bad results by doing that. Never revenge on a loss. There is always tomorrow when it comes to trading. If you try to revenge a mistake, most likely you would end up with another mistake. And revenge to mistakes is the beginning of a snowball. It will lead you to bad places. Never expect each day, week, month to be a winner. Impossible. The market doesn't care what you want. The market would pay as it wants. If you were able to accept it and play by its rules, you would be able to catch your portion. It's impossible to expect a paycheck every day, week, or a month. It's impossible. Don't trade numbers that are bigger than you. A lot of traders do these mistakes. And I keep hearing these claims, but I only have $100 account. If I don't trade big numbers, I would never grow. You would never grow, not because of the $100. You would never grow because that's what you say to yourself. Because if you keep accumulating, slow but steady, and instead of wasting this $100 and then lose them and deposit another 100 and another 100 and another 100, instead of that, play safe on the first 100, grow it to 110. When you can't deposit more, then you have 210. Make it 220, then deposit another 100 when you can, then you get 320, instead of keep blowing and blowing and blowing and staying with the same 100, blow, 100 again, blow, 100 again. I keep hearing that, and it's always a ridiculous claim. I have too small capital, I can't grow if I don't play aggressive. Well, I want you to remember one thing. Small capitals should never, ever think about trading for a living. You can't. But if you keep doing these things, you will always remain in the small capital and never grow to the big capital. Never. And as I told you before, there are enough ways in our reality, more than enough ways to get financed and get a great capital to work with. but you need to prove yourself as a trader. So instead of trying to grow fast, focus on grow smart, proved, correct, and never trade numbers that are bigger than you. Adjust changing market conditions. If it was trending on the previous week, it doesn't mean it will be trending this week. Market changes. Trade facts, not wishes. We discussed about that. Trading is a game of statistics, not a game of being right. Another terrible mistake traders do is, you see, I was right with my analysis. I was right with my charts and with my arrow drawings, expectations. So what? Did you manage to make your money out of it? If yes, perfect. Then you are right. Not just by drawing. Trading is not about being right. No one cares about how many times you are right, how many times you are wrong. No one cares. Well, unless you are analyst for a big company and they pay you money for that. As a trader, who cares? You can be right on 50% of the times and still make tons of money by making simple risk reward in your favor. In the game of trading, the numbers control, not how many times you are right. Do not deny emotions. Face them and deal with them correctly. Everyone says if you want to trade successfully, trade without emotions. How can you trade without emotions? You are a human being. You are not machine. It's like telling the car drive without an engine. How? How? Thank you very much, Mayova. Thank you very much, my friend. Okay, guys, emotions are part of us. Instead of fighting them, deal with them. What do I mean by that? Understand when you perform best, understand when you perform worse. Understand on what conditions you start to make mistakes. Maybe you are too tired after work, maybe you are not performing well after some personal issues, some fight with someone, when your football team lost, when you didn't get your pizza piece you were dreaming about. I'm joking, but you understand my direction, right? Find these moments when you perform best and when you perform worse. I know by myself that if I watch the chart more than I need, I will be doing mistakes. If I'm tired, I didn't sleep well, I can't watch chart because I will force the things to be somehow true. That's personally what happens to me. I never, ever, ever able to trade well, ever, when I'm tired. Make a smart decision. So I close everything. I get a rest, reading a book, doing whatever it is, playing with the kids, doing whatever it is, whatever. Just not trading. And this is what you need to find in yourself. What are these emotions you make you perform best, and what are the emotions make you perform worse? And avoid the second ones, those who make you perform worse. Few last words. That's 100% correct, Catherine. Some people don't know their patterns or performance challenges because they do not journal or see what the issues or the strength points they're dealing with. 100% correct. Few last words, guys. There will be winners, there will be losers. When you win, it doesn't mean you are best trader ever or you have the best strategy. When you lose, it doesn't mean you fail or it doesn't mean your strategy doesn't work. Trading is a business of statistics and probabilities. The sooner you get it and accept it, the sooner you make trading profitable. Don't expect for winners every day or every week. We discussed about that, right? And don't expect for opportunities every day or every week. Like we spoke about the cycles. Sometimes it's uncyclable, meaning it's untradeable. Wait for the setups. Let the market to create the setups for you. Don't create ones. Don't try to convince the market you are right. The market doesn't care. It can bite. Patience is the key for successful trading. You rush, you crush. Slow and grow and fast and blow, we discussed about that. And remember this last one. Dream big, aim even bigger, that's good. But you have to actually wake up and pull the trigger. And this trigger is by making the right decisions. And the right decisions don't go only to the charts. It also goes to the personal decisions. Learn yourself not less than you learn your chart. When you perform best, on what pairs you perform best, on what time frames, on what cycles, on what setups, on what conditions, what sessions, and so on. Journal yourself, learn yourself, explore yourself. Exactly like what happens to us when we are kids and we are teenagers. We explore ourselves, and we are grown up. When we are adult, then we can take these decisions smarter. This is the same journey we go through trading, in trading. Right? We grow. We start as kids, as toddlers, then kids, then teenagers, then adult, then grown-ups that think that they are adults and that they're the best, and then, and only then, after all this journey, we become adults. And when you are an adult, you know the price you have to pay for some things, you know the risks, you know the expectations. So it doesn't matter how old are you when you start trading. When you start trading, you are a toddler. And it doesn't matter if you're 40, 50, 60, or 70, or 20, or 80. Market is a new life, and every life begins from diapers. To grow well to the points where you are able to deal with decisions, don't close your eyes to reality. Face the reality and listen to the advice you can get from adults in trading. Not age talking, but trading experience. Guys, big thank you for being here. I hope this webinar delivered what you expected. I enjoyed as always. You know I love doing that. I wanted to talk about these important things, not just technical part, but also the psychological things that it's so easy to ignore. So thank you very much. As always, this webinar would be uploaded to the members area later today, with the presentation, of course. If you have any question, you know where to reach me. Thank you very much for being here. I wish you a perfect 2019. Let's rock. Ciao for now.